Rick Santelli is standing by at the CME in Chicago. Rick, take it away. What are the numbers?
Yes, well, let's look at Empire, which popped on the wires first. This is a March read. We were expecting a number up 6.4, a big miss, minus 11.8, minus 11.8. That is the worst read going all the way back to May of 2020. So that is a huge miss. Now let's get to our wholesale inflation numbers in the form of the Producer Price Index for the month of February. The headline, month over month, up 0.8%. That is, of course, not as high as the 0.9 expected. 1% in the rearview mirror. And the high water mark was in January of 2021. That was up 1.2. If you strip out the all-important food and energy, the core is up 0.2%. That is 1/3 of what we expected. 1/3 of what we expected. The high water mark there is 1% several times, the last being July of last year. If you remove food, energy, and trade, well, that is up 0.2 as well, and that is definitely a well-moderated number, 1/3 also, because we're expecting up 0.6 for both the X's, X-Food Energy, and trade. Now let's get to the Moneyball numbers. Year over year. Year over year headline is up 10%, exactly as expected. That is the new high water mark going back to record keeping in 2010. The old was up 9.8 several times. If we look at X-Food and Energy year over year, expecting up 8.7, we end up with up 8.4%. That's 1/10 lighter than the highest it's been, which was in December of last year at up 8.5%. And finally, if we strip out food, energy, and trade, expecting a number up 7.3%, we end up with 6.6%. The high water mark there was up 7%. That was the last 2 months of last year. The most recent read in January was up 6.9. So you can see we've definitely moderated a bit. So on the year-over-year numbers, the hottest one was, of course, the headline. It doesn't dismiss all the other data, which was on the year-over-year still on the hot side, but definitely moderating just a bit. What have interest rates done? Well, today they're coming in a bit on the light side. Here we are at just under 2.11. We settled right around 2.13 yesterday. We want to keep very close eye on all rates across the globe, because whether it's in the UK, whether it's in Europe proper, we see that central banks and interest rates and inflation levels are all moving higher, and it's something that we're going to have to contend with regard to how we define the price of equities at a time where central banks are going to be recalibrating not only the U.S., but in many ways we're going to see a recalibration of the global economy with respect to interest rates. Becky, back to you.
You know, we will take it. A nice change in pace to actually see numbers that were not as hot as we'd been expecting. Rick, thank you. Steve Leisman is with us. He's got more on what these numbers mean. He's been digging through it. Steve, what's your takeaway?
I think, Becky, you should take a breath, lean back in your chair, and enjoy this moment, because it's not going to be the situation next month. I think that's really the story. We can,
oh boy,
we can relish this moment of being a tenth under the expectation on the headline PPI, but it is not going to be the case. The core is more interesting. I've heard some chatter from Ian Shepardson and others that maybe we're peaking on the core rate, but what we know is going to happen, just put up a chart of it, gasoline, just put out a chart of oil, and you'll see that huge price spike that we got beginning end of February. And again, this is not arguing that prices weren't high already. They were. They're just higher still, and this is going to show up. You know, one thing you can look at is the change for intermediate goods. That's a little bit further up the pipeline than the headline number we're giving you, which is the final demand for goods. This is further up the pipeline, up 1.6% in intermediate goods. A big part of the headline jump was from gasoline. That's going to continue as we go forward. And really, it raises the question about the outlook that we talked about, which is in the Fed survey that'll be online soon. For those of you who asked me where the survey is, we're just editing it right now. The story is this, is that they have one group of folks who say this huge increase in prices is a tax on consumers that will result in lower demand. Others say, hey, this huge surge of inflation requires the Fed to hike more and it'll be runaway inflation. So, Becky, that's really the debate right now among economists and how they're trying to process this huge surge in commodity prices, which is both energy and food.
Shepard Smith here. Thanks for watching CNBC on YouTube.